So we have current tax. Current tax is the amount of income tax determined to be payable in respect of taxable income or tax loss for a period. Okay, so current tax is the tax which I am paying right now. Okay, after 31st March, my accounts will get audited. Okay, and when my accounts get audited, when my accounts get audited, at that time what I'll do is I'll pay tax. So this time I'm paying tax, and that tax is known as current tax. Now what is deferred tax? Deferred tax is nothing but the timing differences. Nahi samjha. So deferred tax is the tax effect of timing differences. That means, see, as per accounting you have a profit of 1 lakh, and here you have 1,20,000 taxable profit. So here two different tax figures also you'll have. Sometimes you pay a little extra, sometimes you pay a little less. So that extra and less, that you have to adjust, that is deferred tax. Timing differences are the differences between taxable income and accounting income for a period that originate in one period and are capable of reversal in one or more subsequent period. Yes. Now you can adjust that. Okay, you can adjust that. It is not like you cannot adjust. Yes, you can adjust that. So how you can adjust? So suppose you have paid little extra tax this year. Okay, and auditor, after auditing, you came to know that your tax paid was little extra. That you can carry forward and you can adjust against your payment for next year. So that is deferred tax. So you have timing differences, you have permanent differences. Permanent differences are differences between taxable income and accounting income for a period that originate in one period and do not reverse subsequently. So permanent timing differences is you can carry forward your difference amount and you can adjust. Permanent differences are differences between taxable income and accounting income for a period that originate in one period and do not reverse subsequently. So that is what permanent difference. So what is permanent difference? Permanent differences are differences between taxable income and accounting income. They are differences between taxable income and accounting income for a period that originate in one period and do not reverse subsequently. Then you have timing differences. Timing differences arise because the period in which some items of revenue and expenses are included in taxable income do not coincide with the period in which such items of revenue and expenses are included or considered in arriving at accounting income. So you have permanent differences, you have timing differences. So they are explaining permanent differences you cannot reverse anything, but timing differences you can reverse. Okay, permanent differences you cannot reverse, timing differences you can reverse. Timing differences arise because the period in which some items of revenue and expenses are included in taxable income do not coincide with the period in which such items of revenue and expenses are included or considered in arriving at accounting income. So timing differences are, there can be certain items in taxable income but not in accounting income. In accounting income but not in taxable income. That can happen, and because of that you are getting a difference. So they have taken an example 1 and 2. You please go through it. I'll take a pause and then we'll start with recognition. Then you have recognition. Tax expense for the period comprising current tax and deferred tax should be included in the determination of net profit or loss for the period. Taxes on income are considered to be an expense incurred by the enterprise in earning income and are accrued in the same period as the revenue and expenses to which they relate. So we have tax expense for the period comprising current tax and deferred tax. Obviously, tax expense means what? Tax. Tax can be current tax, tax paying currently, deferred tax, paid previously, adjusting now. So that is deferred tax. Should be included in the determination of net profit or loss for the period. Taxes on income are considered to be an expense incurred by an enterprise. Correct. Whenever I pay tax, suppose I have an income of 1 lakh rupees and on that I am paying tax of 1000. So 1000 is nothing but my tax. That's an expense, cost. So tax expense for the period comprising current tax and deferred tax should be included in the determination of net profit or loss for the period. Taxes on income are considered to be an expense incurred by an enterprise in earning income and are accrued in the same period as the revenue and expenses to which they relate. Such matching may result into timing differences. The tax effects of timing differences are included in the tax expense in the statement of profit and loss and as deferred tax assets or as deferred tax liabilities in the balance sheet. Permanent differences do not result in deferred tax assets or deferred tax liabilities. Deferred tax should be recognized for all timing differences subject to consideration of prudence in respect of deferred tax assets. So we have tax expense for the period comprising of current tax, deferred tax that they have mentioned. Then they are mentioning that tax effect of timing differences are included in tax expense in the statement of profit and loss and as a deferred tax asset. Yeah. So what happens is, suppose you are incurring you have paid little extra. Okay, if you have paid little extra, I am an accountant and I have paid little extra tax. After my audit, I came to know that I have paid little extra tax. That is known as deferred tax asset. And if I've paid little less, that is liability. So I need to adjust that accordingly. Deferred tax should be recognized for all timing differences. It is not like today I'll recognize, tomorrow I'll not recognize. No, it will be recognized every year. Okay. The deferred tax in respect of timing differences which reverse during the tax holiday period is not recognized to the extent. So there are some special periods. I'll take one small example, COVID. COVID was a special period where many tax benefits, tax privileges were given to the enterprises. So same way we have a period and that period is known as tax holiday. Deferred tax in respect of timing differences which reverse after the tax holiday period is recognized in the year in which the timing differences originate. Okay, a quick read, then we'll go for recognition of deferred tax assets. Okay, next one. Recognition of deferred tax assets. This standard requires recognition of deferred tax. This standard requires recognition of deferred tax for all the timing differences. So what we do is we go for recognition of deferred tax for all timing differences. Okay. This is based on principle that the financial statements for a period should recognize the tax effect, whether current or deferred, of all the transactions occurring in that period. Deferred tax assets should be recognized and carried forward only to the extent that there is reasonable certainty that sufficient future taxable income will be available against which such deferred tax assets can be realized. So deferred tax asset is nothing but if I have little surplus amount and which I am carrying forward to adjust against my future liabilities, so that is deferred tax asset. I need to recognize that asset and I need to adjust it against my current tax liability. And same way I have a deferred tax liability. Okay, same way I have deferred tax liability. They have not mentioned about deferred tax liability. So that deferred tax liability helps me, again same, whether it is asset or liability, they adjust against current tax. Okay, the amount of tax which I am supposed to pay, that they have mentioned here. Let me move ahead. Reassessment of unrecognized deferred tax asset. At each balance sheet date, an enterprise should reassess the unrecognized deferred tax asset. So if it is unrecognized, you should reassess why it is unrecognized, what you are required to do. The enterprise should recognize previously unrecognized deferred tax asset to the extent that it has become reasonably certain or virtually certain that sufficient future taxable income will be available against which such deferred tax assets can be realized. So we have reassessment of unrecognized deferred tax asset. So at each balance sheet date, an enterprise should reassess. We should reassess what is the amount left, what is the amount which we have paid extra, what amount needs to be adjusted. We need to reassess that. Measurement. Current tax should be measured at the amount expected to be paid the taxation authorities using the applicable tax rates and tax laws. Deferred tax assets and liabilities should be measured using tax rates and tax laws that have been enacted or subsequently or substantially enacted by balance sheet date. When different tax rates apply to different levels of taxable income, deferred tax assets and liabilities are measured using average rates. Okay, so measurement, how to measure our taxation, how you'll adjust that, that measurement is given here. Then review of deferred tax asset, okay, you'll show it in the balance sheet. The carrying amount of deferred tax asset should be reviewed at each balance sheet date. An enterprise should write down the carrying amount of deferred tax asset to the extent that it is no longer reasonably certain or virtually certain. So it needs to be adjusted. In simple words, it needs to be adjusted. Disclosures and presentations, you should disclose legally enforceable right to set off the deferred tax amount, and you should set off that, you should carry forward it, you should set off it. Okay, so whether it is deferred tax asset or liability, it should be set off. Deferred tax assets and liabilities should be distinguished from assets and liabilities representing current tax for the period. Correct. Deferred tax asset and deferred tax liability is different. It is a different concept. Okay, compared to current tax. Okay. Then we have transitional provisions accounting for taxes on income. On the first occasion that the taxes on income are accounted for in accordance with this standard, the enterprise should recognize in the financial statements the deferred tax balance that has accumulated prior to the adoption of this standard as deferred tax assets or liabilities. So how you will recognize, what you will do here, transitional provisions accounting for taxes on income. Okay, then you have comparative analysis and the illustrations. Illustrations are very easy. You just have to recognize. They have given you unabsorbed depreciation. What is that? You have to mention whether it is deferred tax asset, liability. Income tax penalty, you have to mention. Then under 14th illustration, they have given you the amount, the different years, and based on that you just have to add and subtract. That's it, and you are done with your answer. So timing difference, permanent difference, will take a difference of it. You will get the taxable income, and on that you have to add your 40%. You will get current tax. Done. 15 sum again same. Okay, please go through it. I hope you are comfortable.